Ladies and gentlemen, good day and welcome to the Lakshmi Cement Q1 FY24 earnings conference call hosted by Phillip Capital India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Agarwal from Phillip Capital India Private Limited. Thank you and over to you, Mr. Agarwal.
Thank you, Melissa. Good evening, everyone. On behalf of Phillip Capital India Private Limited, we welcome you to the Q1 FY24 call of Lakshmi Cement. I need to highlight that Lakshmi Cement is also the holding company of Udaipur Cement Works Limited, and therefore this call is also open for discussion about the performance of Udaipur Cement Works Limited. On the call we have with us Mr. Arun Kumar Shukla, President and Director, and Mr. Sudhir Bidkar, CFO of Lakshmi Cement. I would like to mention on behalf of Lakshmi Cement and its management that certain statements that may be made or discussed on this conference call may be forward-looking statements related to future developments based on current expectations. These statements are subject to a number of risks, uncertainties and other important factors which may cause actual developments and results to differ materially from the statements made. Lakshmi Cement Limited and the management of the company assumes no obligation to publicly update or alter these forward-looking statements, whether as a result of new information or future events or otherwise. I will now hand over the floor to the management of Lakshmi Cement for their opening remarks, which will follow by interactive Q&A. Thank you and over to you, sir.
This is Sudhir Bidkar from Lakshmi along with my colleague Mr. Arun Kumar Shukla, welcoming you for this Q1 FY24 call. You would have seen the results and we don't have any comments to add other than that now the floor will throw the floor open for question answer so that we can take maximum questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Shyam Sundar Shriram from Franklin Templeton. Please go ahead.
Hi, good evening. Thanks for taking my question. We had highlighted in our press release clinker capacity utilization almost touching 97% and cement utilization at 85%. With such strong utilization and our geo-mix strategy, it appears our operating performance could have been better. So in this journey of improving EBITDA that we have embarked on, what according to you could have been better on the realization cost front and where lies the scope for EBITDA improvement?
Thanks and good evening to all of you. I'm Arun Shukla from Lakshmi Cement. Yes, I think a couple of points I think you could have done better because if you look at volume which is alright, our NSR realization also looks alright. Okay, which is in line with what others are doing. In 2-3 points where I feel we would have done better. Of course, first better volume. I think we have some headroom, right? Okay, so 85% capacity utilization of cement, so we could have done better on volume one. Second is we could have done better on operating cost, which is a little bit higher, right? And third, I think if I'm looking at what others have published till now, employee costs, I think these are the 3 elements I feel I think we have gone little away.
Thank you for that, sir. On the as you talk about volumes, which regions, if you can share some regional perspective between north, east and west, which were some regions from our utilization, how were the utilizations in these regions for us? Any perspective that you can share and how that has improved either sequentially or year on year or declined, that would be helpful to understand, sir.
Right. So I think our east utilization about 90, and
Sorry,
northwest part of it, I think it's lower than 90%. Overall is 85%. I really kind of give you a sense as to where we could have done a better volume. I think in west, because as I told you during my last call also that we have a firm geo-mix strategy wherein we plan to sell more in the areas where our realization is better. And if you recall, I suffered a setback on account of the cyclone which happened in Gujarat during latter part of right. And in the month of April also, March end there was Holi and there are issues of labor unavailability in part of Gujarat because payoff during the post Holi is little higher than other part of India, right? I think there we have I could have done better volume than what we do normally, right? What we have done last quarter, and also I think part of India. Because post this cyclone, in fact, Rajasthan was also impacted quite heavily. So there also, I think our volume went down. And if hands-on volume is about 25% in north and western part of India. So I think that is what has impacted our volume. Just to give you a sense, whatever information I am having, we have grown better than industry of it. So as per my estimation, I think growth is about 16% in eastern part of India, and we have grown more than 16%. But in case of north and western part, west, if you take, then we are in line with industry. But central part of India, which is in our case Rajasthan and western part of MP, we have lower than the industry. So that is what the impact is, because if northwest volume goes down, then overall volume goes down, one. And this also impacts our realization, because realization in northwest part is better than. So I think I would say the regional nuances which impacted our performance in quarter one of this year.
So as we look forward, while I understand this is we are getting into a seasonally weak quarter with the monsoons setting in, but post that, do we anticipate this situation to get remedied as we get into Q3, Q4?
Yeah, for sure. I think this is just most phenomenon. And being, kind of, too heavily on north and west, that was natural way, right? But I'm pretty sure this is the most phenomena, and we are going to just come back to original self, right?
Understood. Sir, on the operating costs, other than the employee costs, we leave aside the staff costs, where else do we think there lies some scope for betterment?
I think we could have done little better on our, HR, I think, because we had one breakdown in one of our plants. So, waste heat recovery production was lower than last. I think that is one area I think we could have better. But unfortunately, I think we had one breakdown that impacted our, power cost a little bit. One area I think is which we need to really work on going forward. Apart from that, I think power and fuel we have done all right, in line with industry. In fact, better than some of the so we are better than them. But the power and fuel, I think, is going to give further maybe leeway going forward, right? We are aligned in that part. Power cost per se we are little bit higher because of the reason I told you, lesser WHR production. So this is what it is, I think, in summary.
Understood, sir. Thank you very much for that. Sir, on the capacity expansion, post the UCW expansion that is underway, is there an inorganic strategy as well? If so, what are some white spaces from a regional mix that we'd like to address, and your thoughts on the upper bound on valuations, if you can share on those aspects? Thank you.
See, after UCWL expansion, which our capacity will be close to about 18 million tons, and we have the vision of going up to 30 million tons, as we mentioned in our earlier calls also, and that gap is to 30 to brownfield and the greenfield expansion. Brownfield can happen at to start with, and then followed by another line in Udaipur. And we have, as we mentioned in the past calls, we have two mines recently been awarded, one in Nagaur in Rajasthan and Kutch in Gujarat. So those greenfield can take us to 30 million tons by 20.
Sure, sir. Sir, I was more trying to understand if there is any thoughts on inorganic acquisitions, which is also part of this, and if so, how would we think on the valuations there?
Plans, yeah, we have plans to reach 30 through the field and but I think we always evaluate that always if it comes at the right valuation, we evaluate.
Okay, and what would be the upper bound, sir, for such valuations? Anything internally that you would think of and you can share?
No, there is no limit as such. It has to make synergical sense to us. That's all.
No. Understood. Thank you very much, sir. Best wishes. I'll fall back in the queue. Thank you.
It is, I think, one thing which we see is strategic fit, because we are not going to grow whatever comes on the way. That has to make a sense, and what Mr. Vish mentioned, it has to really add, value and the right value. These are the two primary criteria which we apply.
Understood. Thank you, sir. Thank you.
Thank you.
Thank you. Management, before we move to the next question, we would like to reconnect your line, sir. The audio from your line is breaking. Participants, please stay connected while we reconnect the management. Ladies and gentlemen, we have the line for the management reconnected. We will take the next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Yeah. Good evening, sir. My first question is on your guidance. Last quarter, we discussed targeting around 19% volume growth and 1,000 rupees EBITDA per ton by the end of this year, exit of this year. Where are we in terms of that? And after very weak first quarter results, would we want to revisit this guidance?
Yeah, so I think this is what the target we have taken, 19%. Typically, I think one used to be always good, right? But I told you between our geographies, I think we had some accidental situation, I would say. The cyclone and little bit longer layoff forcefully. So that impacted this thing. But still, I think we hold on to our volume growth, what we planned at the beginning of the year. There is no revision as
But we are already operating at a very high utilization, both on clinker and cement. So how the growth would pan out like in following quarters, which will result into such 19-20% kind of volume growth?
Yeah, so the plan is like we'll have clinker out of our works limited, right? And that
your line is still not clear. I think it's a lot of disturbance there.
Audible? No.
So one moment, let me try this again. One moment. Please go ahead. Participant, could you repeat your question, please?
Yeah, I was asking that with high utilization both of cement and clinker, especially clinker, how do we plan to achieve the guided volume growth?
Yeah, so UCWL will be taking out clinker from October this year, right? I said during last call also that one, I think we are going to use clinker. Some of the grinding is still we have that another 10% capacity, I think, headroom. So that is one. Second, we do have some tie-ups with external parties where from we can grind cement. And we do have some tie-ups, and even now also we take little bit volume out of that, right? So that grinding capability will complement with outsourced units which we have already tied up. So second, so these are the two I would say levers which we are going to use to reach to that level of growth which we have envisaged for this year. So our own grinding station capability utilization, and second, outsource utilization out of the clinker which we are going to produce from Udaipur Cement Works.
And what will be the runway of our unit EBITDA from current quarter 610 rupees to 1000 rupees by the end of this year?
So here I think 1000 rupees, this is what I think our plan is, and all actions which we have kind of put in place is internal, right? And we are moving, I think, in a right direction in terms of geo mix. We have kind of moved in a right direction. I think I told you that high realization area 75% volume we are selling now, which used to be about 70-30 in favor of Northwest before. Now it is 75-25. So there we have moved very well. Second, I think within the regions also we are optimizing our volume. So let's say within Northwest, the areas where I think, let's say Western market where we get better realization. So selling more volume in that area, and within North, wherever I think those markets where which are closer to our plants and remunerative, we are going to sell volume. So that I think we are doing all right. Second lever, I think I mentioned you on premium product. So we are progressing very well. Now we have reached to about 26-27% of premium product, which was last year we closed at about 21-22. So there also we have improved very well. So that is second. Third was blended. I mentioned you that we want to go to about 75%. We have reached to about 66-67% now, and that is because of the higher volume in Western market, which is predominantly OPC market. So that is what the reason is. But still, I think we are working on reaching to 75% of our blended cement volume. And next, I think on lead and other supply chain efficiency which we had envisaged. So that we are working on. We are using technology. So OTM, Oracle Transport Management, we have deployed recently, and that has started giving benefit now. So probably in coming quarter, I think we'll get benefit from logistics end also. Another thing which I mentioned before was that we are working on AFR, alternate fuel capabilities at different plants. Probably, I think I'm sure that by October we'll be commissioning our AFR capability at Sirohi, and our plan is to take our TSR from currently 4% to about 10% very quickly once I think that facility is there. So that is another actions which I told all of you before. And of course, I think we are coming up with AFR capability at our Udaipur Cement Works Limited as well, right? We are putting up some improvised capability at our Durg plant with very low capex. So that is also going to give us the benefit in terms of increasing our AFR. So these are the actions which we are taking. Some of the actions have already, I would say partially fructified, and some of the actions I think will get realized in coming months. One of the examples is AFR capability which we are going to commission at Sirohi in the month of October. Parallelly, we are also working on renewable energy. I told you that in a captive mode, we are putting up 56 megawatt solar power plant in Durg, with a third party with 26% equity from our end. So that is also going to get commissioned in the month of October. So all these things put together, I think I feel that we are on right track and will hit that target which we have set for ourselves to achieve 1,000 rupees EBITDA. When I spoke to you about 6 months back, that timeline was 2 years. So still I think 18 months are there and will reach there.
Sure, thank you. One more question on your capital enabling resolution for 2,500 crore of capital. So, by what time period we are looking to utilize this capital, and is there a time lapse for this?
Well, there is no time lapse. Once we have taken that enabling resolution, we can do the fundraising within a year.
Within a year. Okay, sure. Thank you, sir. These are my questions.
Thank you. We would like to remind participants, if you have a question, you may enter star and 1. We have the next question from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Sir, with regard to this enabling resolution, 2,500 odd crore. So, I know we are in active discussion for Sanghi Cement's acquisition. So, based on that enabling acquisition, it suggests that we are looking for around 45 to 5,000 odd crore acquisition or consideration, assuming 2,000 crore debt at Sanghi. So, what's the thought process there? And if we are positive, or if we succeed to get that particular asset, then what about the organic expansion? Because if we see East market, we are the smallest player there. All the players who added capacity at your time, when your plant came in Durg, all are at around 3x of their capacity. There we have not expanded capacity, and at Udaipur also we are looking at the second line. So what's the progress, or what's the thought process there? Because if we go for this particular 5,000 or 4,500 odd acquisition, we would be starved of the capacity of the funds to fund our organic expansion. Really, if you can share some thought process on that particular part.
You are right, Kamlesh, that we have not grown that much as others have grown in the eastern, and the reason which we have been saying for quite some time has been that due to the non-clarity on the railway siding, we have not been able to expand our capacity. The good news which we'd like to share with all of you is that finally we have got the approval for setting up the railway lines. Whatever was the impediments, those have all been cleared and the approval is in place. So that gives us an opportunity to expand at a fast pace with the railway siding in place in the eastern region and reach out to the markets which are having high realization markets with movement of clinker through the railway siding. That should be in place in about 9 to 12 months time, now that the approval is in place, and the visibility of that coming up in the near future is quite clear now. Yes, that was the reason as to why we have not been able to grow. Then once we complete this UCWL expansion, then there could be a possibility of another brownfield there that coming in. So you are right to that extent that we have fallen back. We have not been able to grow in the east as fast as others have grown. Now that clarity has come, we will be in line with the growth of the other players.
But if this Sanghi acquisition goes through, and then how this whole organic expansion will shape out? Because entire capital would get blocked there. So how would we grow our expansions, organic expansion? Because honestly, say 4,500 or 5,000 crore spending at that particular inorganic acquisition, say you would be around, your Gujarat would be around 50% of your capacity. And on top of that, there are no good backup plans in case of Sanghi for that movement to the western, say Maharashtra or the Mumbai market. You would have to spend another 500, 600 crore over there. So how we are looking at that? Because for the size of ours, we should only be focusing on the organic expansion.
We are focusing on the organic expansion only. Inorganic, we evaluate the opportunity, and if it comes at the right cost and makes synergical sense, we do take into account. So, but our focus is always been in the past also on the organic growth only.
And lastly, on the, like say, for last 3-4 quarters, we have been so upbeat, or like say, we have been so vocal about this geo and geo mix, and then optimizing our NSR. But honestly, for the last 3 quarters, it's nowhere visible. Like if I compare it with all the peers, be it in East or the Gujarat market, they are way ahead of us in terms of margin. Like say on the consolidated margins, we have done hardly around 615 rupees, and our, like say, the gap with our all other players, now that has expanded to around 300-350 rupees. So what's happening on that particular part? Because if we are impacted by this whole storm or the flood, all our also, other players are also impacted. If you see Sri Digvijay Cement, their volumes have increased by around 18% year over year. While in our case, like say, we have expanded our growth is hardly around 5% year over year.
What Kamlesh you are saying is absolutely right, that we have been talking much on that bridging the gap. But barring this quarter, especially this quarter has been pretty bad for us, we were able to bridge. If you see our gap between the peers, we were able to narrow it down from almost 500 rupees plus to close to about 200 rupees. This quarter was a setback for us. You are right that the rains and cyclones impact everyone. But for us, it was slightly different in the sense that it hit 2 regions which account for almost 70% of our sales, Rajasthan and Gujarat. So that was the reason as to why, while others were able to balance it out with the increase in sales from their other regions, for us there was no backup from the eastern or the northern side. The impact has been severe for us, more than other players, because of Rajasthan and Gujarat accounting for almost 70% of our sales. But we are confident that going forward we'll be able to again bounce back and bridge this gap. Your concerns are well founded, that we have been talking big and not have been able to deliver. But barring this bad quarter, which unfortunately was for external reasons, we are quite confident we'll be able to bounce back and bridge that gap going forward, as Mr. Shukla has explained in detail on various parameters through which we'll be able to narrow that gap and reach that magic figure of at least 4 figures of EBITDA in about 12 months time, 12 to 18, whatever we have projected.
Thanks, Vidkasa, for very straightforward answer. Very good. Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. So just to reconfirming, when we are saying a 19% volume growth, so this is on the Concall volume that we have done in FY23. On that, we are saying a 19% growth still we can achieve.
Yes. Over FY23 only.
Yes. So yes, sir.
Yeah.
Yeah. So that means for next 9 months, the ask would be a 23% plus kind of a growth that we have to do. So just to reconfirm, at least in June, July, heavy seen that kind of a run rate, that kind of a growth.
That is what we are trying. I think arithmetically we cannot put on a pro rata basis, because July or September typically lean months, and I told you that October we are going to have clinker also in place, right? And from October I think we'll have a good impetus on volume growth, because we'll have clinker. That 97% clinker utilization we have already done, and grinding is about 85%. So once I think clinker is available and we have grinding capability which is available at different locations, we will hit that. Maybe I think growth rate is going to be much more beyond October. But July, August, September typically I think low months, So definitely we'll do better than others, but I would not say that we are going to kind of, run at the rate of, 23%.
Okay, got it. And second aspect in terms of the, though definitely Bitka sir has mentioned in the previous reply, 1,000 rupees EBITDA that we are reiterating to reach in next, let's say 18 for this year, considering the first quarter broadly, just trying to understand in terms of the on full year FY24, last time we said close to the looking at, so broadly where one can see and on a full year FY24 we can look at.
So I think I'll let you know. I think we are not ready that, what is the landed, kind of, EBITDA by end of the year, but maybe I think I'll let you know.
Okay, sir, I need many data points for this quarter. So just starting with the, if we can share the Concall standalone clinker sales, then trade share for this quarter, lead distance for this quarter, rail mix for this quarter, gross debt and cash standalone and Concall as on June.
I will start with the reverse order, with the debt numbers. Standalone, our debt as of June on a standalone basis 770 crores and on a Concall basis 1950 as of June, right? And a cash balance about 900 on a standalone, 950 on a Concall basis.
Okay.
Other questions regarding the sales. You had asked about the railroad mix and the sale, no?
Yeah.
I think we are very heavy on road quotient. It's about 10% is rail and 90% is road.
Okay. Trade sir for this quarter, sir?
So trade is quarter 55%. Yeah, 55%.
Okay, the same because we for last 3 quarters we were saying that we want to reach to 60%, and in last call we said that in March we reached to a 60%. But
not being bothered about trade, non-trade, we are focusing more on the, as we have been explaining, on the geo mix. Right. If trade in the certain market is higher than the trade in the other zones, obviously we'll sell more in non-trade, right? So that was the reason. So geo mix is a better parameter for us. Right. Anything which adds to the ultimate EBITDA. That is
okay.
So we give priority to geo mix than to a trade, non-trade. Ultimately, yes, with even a particular market that non-trade is higher, our focus will be to focus trade and non-trade, and then go to the other market where the trade is lower than the non-trade of the high price market. And
okay, sir. Lead distance, non-cement revenue, and that, and then finally the volume clinker sale at standalone and Concall.
It is about 400 overall.
Overall is 400 kilometers lead.
430 odd in the northern side and about 300 in the eastern side. And about your clinker sale, we have done a total clinker sale of about 2 lakh tons out of the total in this quarter of 32 lakh tons. 2 lakh is the clinker sale.
Okay. Non-cement revenue and RMC revenue for this quarter?
You are doing a very detailed analysis.
133 crore is non-cement revenue.
133, sir.
133, out of which 63 is the RMC.
Okay, 63 is RMC. And broadly in terms of the margin for that last quarter, it was 5% for non-cement revenue. So will it be the same or has it improved?
It is fallen to 4%. Out of on the sale of 133 crores, out of the total sale of 1633 crores, so about 1500 is the our cement sales, and 133 is the non-cement sales. And on the non-cement, the margin is operating margin is 4%.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. We have the next question from the line of Parth from Investec. Please go ahead.
Yeah, hi sir. So thank you for the opportunity. So I had a few questions. So the first one is on that you mentioned earlier that we won few leases in Gujarat and Rajasthan. So wanted to understand what is the reserve size like, what is the premium paid over there, and by what time do we plan to exercise this growth optionality?
Premium etc. is all in the you can see I don't have the figure readily available, but it has not been exorbitant premium which we have paid. It has been almost a year that we have acquired those mines. That is number one. Number two, we are focusing initially on the Nagaur mines in Rajasthan. We have started the land acquisition process, and Kutch will be after some time.
And so what are the reserves like over here?
Reserves also will let you know separately, but that is all in public domain.
Hello?
Yeah. Don't have the figure right now with us in the call.
Okay.
But I think both the data on the premium at which that those mines have gone as well as the reserves available are in public domain. Still, you can send a mail, respond to that.
Okay.
I don't have ready available here.
Okay, sir. So the second one was regarding, so how should one read into this debt resolution of rupees 2,500 crores? So what would be, what this will be used for?
Sorry, come again?
So this 2,500 crores that we are planning to raise, this would be used for organic and inorganic expansion?
Yeah, it is an enabling resolution because if we have to grow organically or inorganically, we don't have to rush back either to the shareholders or to the board for that approval. So it's enabling, and we have the leeway of doing the fundraising in about a year's time. We are not doing it tomorrow.
Right. Okay. Okay, and sir, there is one question on related party transactions. So if I look at H1 FY23 numbers that we have shared, in that there's a number of 300 crores which is under purchase of cement. So this is pertaining to what exactly?
300 crores, sorry, come again?
There is a number of 301 crores, 302 crores under a purchase of cements and others. So this would be pertaining to what?
Just give me a second.
Yeah.
Purchase of cement. Purchase of stock and trade is there.
Purchase of cement.
No.
Under related party transaction. 3019 is the figure.
You are talking of which report you are reading? Sorry.
This is related party transaction that we have disclosed on H1 FY23 basis.
Yes, that is basically the normal purchase of clinker and or the cement purchases which we are doing from our subsidiary Udaipur Cement Works.
Okay. So can you help me with the clinker and cement volumes, or, like both in value and volume terms related to this transaction? Is it possible?
Yeah, this would be primarily it is cement which we are sourcing from Udaipur. It is about 2.35 lakh tons.
And
in this quarter, I'll explain it. JK Lakshmi on a standalone basis have done us a total sales of 29.25, right? You can note down, right?
Okay.
29.25 is the total sales of JK Lakshmi in this quarter on a standalone basis,
Right.
Which includes 27.64 of cement and 1.61 of clinker, right?
Right.
And you add there to 5.15 lakh sales of UCWL.
Okay.
That again breakup you can note down, and out of 5.15, 4.71 is cement and 0.44 is clinker, right?
Right.
So the total of JK Lakshmi 29.25 and 5.15 is 34. 34.4. But in the consolidated we are reporting 32.05. So the difference between the summation and the console number is the inter-unit sale of 2.35. for which that 300 watt figures you are talking of pertains to the related party transaction of the inter-unit sale of cement between JKLC and UCW, which is knocked off in console number. So on console basis, it is 30 lakh tons of cement and 2.05 lakh tons of clinker, making a total of 32.45.
Okay, and this would be all cement. No.
It is all cement.
All cement.
But going forward, as we see the production from the clinker line of UCWL started coming in from October, there will be an increase in the clinker sale from Udaipur to JK Lakshmi in the third and fourth quarter.
Okay, until the time that grinding unit at UCW comes up.
Yeah, you're right. That is still maybe 6 to 8 months away from their clinkerization line. So till that time, their grinding unit comes up, we will be using that clinker for grinding at our location.
Okay. So, sir, would it be possible to share the same numbers for even FY23? Like I could, write a mail to you, and you can share it over mail. Yeah.
The full year I don't have it readily, but you can mail it. I'll respond to that.
Perfect. Thank you so much, sir. Yeah.
Thank you.
Thank you. We have the next question from the line of Hospital. Please go ahead.
Good evening. So just wanted to clarify, the target of 1,000 rupee per ton is including the fuel cost benefit that we're seeing, or it's excluding that?
So as I told, I think this is excluding, right, all internal efficiency, because we wanted to bridge that gap of about 300-350 rupees.
So industry, I understand, is having or estimating like a 300 rupee cost benefit from foreign fuel cost. So then basically we should expect 1,300, right? Is that understanding correct?
So I think our estimation is little lower on fuel cost for this thing, because we are already there at about 2.3 now around, right? So maybe
spot is but
it started going up. Right.
Okay.
I don't think 300 headroom is there for fuel cost. This is what my estimation is. Maybe.
Okay, but whatever industry will get, basically that will be additional over and above 1,000.
Yeah.
And earlier I know you had given a roadmap for reaching 1,000. Like it's been, I think, almost a year since we had spread out that roadmap. So how much progress you think we have made on geo mix and other aspects around cost and all?
So that is what I was trying to explain, that on geo mix we have been able to optimize to an extent. About close to 75% of volume in north and west part of our geography, right? And within north and west, I think in core areas. So that is one. Second, on premium product, we have improved quite a bit. So we have gone to about 27%. Okay, so this is second. Third, I think I told you that logistics using technology, if you can take some advantage and revisiting our distribution network. So that project is in progress. So probably I think we'll get this benefit in coming quarters. And third was on alternate fuel capability, which we are setting up at Sirohi, and some kind of improvisation at Dur, capability at Udaipur. So this is what I think progress we are making. Some of these actions which I explained you before are work in progress. So maybe another 3-4 months time, those some of the actions will get fructified. Then we'll start getting benefit out of that. We are also working on renewable energy as to how we are going to improve our renewable energy proportion in our total consumption. So right now we are close to about 30%. So our plan is to go to about 37 to 40%. So for that we are setting up 56 megawatt under captive mode in East and another 7 megawatt at Sirohi. So these projects also will get concluded in the next 2-3 months time at Dur and about 3-4 months time at Sirohi. So that will also give some benefit.
Got it. But would it be possible to have some numbers around it? Because on realization, if I'm not wrong, you had mentioned like 150, 175 will come from realization. So have we got like maybe 50 to 100 out of that already? Like how should we think on number terms on these things?
Definitely, I think we have got out of, I mentioned about 250 plus around on realization, right? So definitely we have got about 50 to 75 out of it. And if you look at our realization, I think we are reasonably all right, placed with the leaders in the industry.
Okay. Sure. And also like on this clinker purchase that you would do from Udaipur, just to understand like how will the cost work on that, like purchase cost, how will the margins be split basically between Udaipur and JK Lakshmi on that?
They will be doing it on a cost plus basis.
Okay, sure. And lastly, any thoughts or clarity around merging UCL, UCWL, like FY25, FY26, anytime we can expect?
Yeah, we'll be certainly doing it once we graduate in JK Lakshmi to the new regime of 25%. And for us to graduate, we need to first exhaust the MAT credit outstanding, which earlier used to be 200 crores, has narrowed down to now 140 odd crores. So maybe in a couple of years we'll exhaust that MAT credit entitlement and then we can graduate to 25% and collapse the structure. So maybe 2 years away may still.
Sure. Thank you. I'll come back in the queue.
Thank you.
Thank you. We have the next question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hi. My question pertains to first, could you share the clinker production at Udaipur and standalone entity?
Production of clinker in the standalone entity in this quarter, our clinker production was 16.65 lakh tons. Okay. And for it was 3.88 lakh tons.
What was the fuel cost on a consolidated per kcal?
Our fuel cost in this quarter on kcal basis was 2 rupees 23 paisa.
And this was what number in Q4?
In Q4 it was 242.
Okay, and how are these numbers trending as we, in month of July?
In the coming quarter, we expect it to further go down from 223 to about 215 also.
Okay, but why is this softening? You're looking at a very smaller number because petcoke prices and all have come down significantly. So the current spot prices, by when do you look them to reflect in your numbers?
Time lag between the cost reduction and its impact in the P&L is ranging between 4 to 6 months, depending on the prices which you are carrying.
Okay.
Eventually it will come, but based on the inventory levels in the coming quarter, it will be slightly lower at 2.15, likely to be.
Okay. And this 40 megawatt solar capacity which you talked about, this is on an installed capacity basis 40 megawatt, which would have effective 10 megawatt availability, or it is actual 40 megawatt which you would be sourcing?
You are right. You are right on the installed basis. Based on the PLF about 20-25%, you are right. Effective availability could be 8 to 10 megawatt only. But the big advantage in that arrangement, especially in the state of Chhattisgarh, is that they allow the banking of that power generation and can be used in the non-generating hours. So that is a big advantage.
And what would your costing would be just overhead cost?
No, costing, since we are not making an investment, our landed cost would be about close to 5 rupees.
Oh, 5 rupees.
Yeah. Great, as opposed, because we are not making any capital investments, only a 26% is equity stake costing us.
Okay. And sir, what would be your grid cost currently?
It is more about 7.5 rupees in East. So if we are getting at 5 rupees per unit, there is a 2 rupees plus saving.
So given that these solar power plants have such a strong payback period, would it not make better business sense to have it captive than going through? Is there any other cost which gets up? Like any incentives which, like you said, the banking and all, which prevents you to having on your own books and just incur the overhead cost?
So you have to have adequate land for a 40 megawatt. You have to have huge land bank available.
Mm-hmm.
The first foremost requirement. But ultimately, yes, it makes sense if you can have that sort of a land to do it in a capex mode, as we are doing in Rajasthan, where they are imposing even on the captive 26%. They are putting the cross subsidy and the electricity duty, etc.
Oh.
In Rajasthan it is not allowed. So we are in fact doing the reverse thing in Udaipur. There is a 7-8 megawatt of power project which we had started in the captive third party route. Now eventually we are forced to buy it and put it under the capex mode because of the policy of the Rajasthan government. So yes, ultimately it makes better sense to put, if you can and have the necessary resources and the land, to put it in the captive or the capex mode. But the policy of the government has to support that.
Right. So then last question on the balance sheet. We are net debt to EBITDA of 1x, and given there's the market chatter of you bidding for Sanghi, while you may not confirm, I agree, I accept that, but could you give us a sense to the minority shareholders, what are your peak net debt targets or, leverage factors which you would be, following, or a no-go area, at least because given that JK Lakshmi has repaired its balance sheet after long, and this has helped the stock move up. So, could you give us a sense what sort of leverage number you're looking at while you would be pursuing your growth?
First and foremost, we don't distinguish between the majority shareholders and minority shareholders. We take all the shareholders together. They are part of the shareholders family. That is number one. Don't treat anybody as a minority shareholder, even if they are not part of the promoters group. We have never made that bifurcation or distinction. That is number one. Number two, whenever you are doing any expansion for a temporary period, you may sacrifice certain ratios, so long as you have a clear visibility that going forward in next couple of years, whenever the commensurate EBITDA from either the new plant or the expansion which you have done comes in, or any acquisition which you have done. Like take the case of Udaipur. They have just completed the rights issue of 450 crores. Prior to that, their EBITDA used to be in the range of about 150 crores. And they have contracted a debt of 1100 crores for the expansion. Now just before the start of the expansion, the existing debt of 500 crores together with the 1100 crores of the expansion debt, the debt number looks like 1600 crores on an EBITDA of 150 crores, which looks haywire. But moment that expansion EBITDA starts flowing that number gets narrowed down and comes within the visible range. So also whenever at a console level you also see either you go for the expansion or any inorganic growth. For a couple of years, 1 or 2 years, it may be haywire, but so long as we have the clear plan that it will be narrowed down to the range of about not the debt to EBITDA not more than 3 or 3.5, 4 max, that should not be of concern, being a temporary phenomenon. So long as the clear visibility is there. Talking on a prudential norm, yes, you are right. 3 to 3.5 is the outer limit, but can be sacrificed for exceptional cases.
Thank you. Ladies and gentlemen, this is the final reminder. If you have a question, you may enter star and 1. We have the next question from the line of Sanjay Nandi from VT Capital. Please go ahead.
Yeah, thank you, sir, for the opportunity. So can you please guide us on the inventory of coal we are holding as of now? Like what kind of 3 months inventory or what has been the shipment as of now?
Sorry, come again, please. Can you repeat your
Can you
question?
please, sure. Can you please guide us on the coal inventory or the petcoke inventory which we are holding? Like what kind of 3 months inventory or what is the shipment have been done for this quarter? If you can throw some lights on that.
We are holding an inventory of about 100 odd days.
Okay, sir. Thank you so much, sir.
Thank you.
Wish you all the best.
Thank you. We have the next question from the line of Mudit Agarwal from Motilal Oswal Financial Services. Please go ahead.
Yeah, good evening, sir. Thank you for the opportunity. Sir, my question is pertaining to the, again, on the inorganic growth opportunity. Sir, at what valuation we are comfortable to acquire any assets for the acquisition? What's your thoughts on this?
We have not assigned any number for any acquisition value. Depends on what benefit that asset drives to us and whether it makes synergical sense. So it could be different figure for assets located at different place. Ultimately, it has to be seen in a case-to-case basis. There is no fixed number there too.
Okay. And this last question on the net debt side. What is the current consolidated net debt? I missed the number, sir, earlier.
No issues. I'll read out that. It is a net debt is of 1,000 crores as on date. 1,950 is the gross debt and 950 is the cash.
Okay. Thank you, sir. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, we will take one last question from the line of Uttam Kumar Shrimal from Axis Securities Limited. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, what is our CapEx guidance for FY24 and FY25 on a standalone level?
We have CapEx on 2-3 counts, which is presently underway. We are working on a wastage recovery, as we mentioned, of about 3.5 megawatt. Then there's an AFR project going on. We are doing some AAC blocks at Alwar, plus the solar power also. All in all, about 400 crores of capex is lined up. And now that the approval, as we mentioned in response to our earlier call, the approval for the railway siding and the conveyor belt having been there could be some capex of about 100 odd crores, 100 to 150, maybe around in that range on that. So maybe 300 plus 100, around 400 in this year.
400 in FY24, sir?
Yeah, out of which we have already done about 50 odd in the first quarter.
Okay. And sir, what has been our fuel mix in this quarter? Petcoke, coal and alternate fuel?
Yeah, we have done about 40% coal, 43 odd percent petcoke, and the balance is the other, so biomass and others.
Okay. And sir, you said about premium cement is around 25% on overall sale or trade sale? 27%?
Trade sale. This is always on trade sale.
Trade sale. Okay. Yeah. Okay, sir. That's all from my side. On all the best to you.
Thank you. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference back to you.
Yeah, thank you. On behalf of Phillip Capital India Private Limited, we would like to thank the man of JK Lakshmi Cement for the call, and many thanks to the partner joining the call. Thank you very much, sir. Melis, and now come to the call. Thank you.
Thank you, Mr. and all the participants.
Thank you. Ladies and gentlemen, on behalf of Phillip Capital India Private Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.